Assalamualaikum and good morning. I'm Muhammad Nazrin Farhan. I'm from Group 6 with my other teammate Nurul, Shazlina and Muhammad Firdaus. Now I will present to you the concept of cost of capital. Cost of capital is the cost of the firm's debt and the equity funds. Cost of capital also is the required rate of return of a portfolio of the company's existing securities. Cost of capital is used to evaluate and decide a new project. Cost of capital are determined by computing the cost of various financing sources and weighing them proportionately to their designated use in the capital structure. It is important to maximize the firms of value to make sure the cost of capital can be minimized. Cost of capital also can be used in making a capital budgeting decision. The budget are decided through a capital structure element are weighed to obtain the minimum overall cost, and then the financial performance and investment acceptability may be determined from analyzing the discounted cash flow. Debt and preferred stock carry inherent risks that we never expected. Next, debt is adjusted to the lower to reflect the tax-deductible interest. And last, retained earning of the common stock is the current dividend yield plus anticipated future growth of rate. Capital element can be used to obtain a minimum overall cost. The debt component that results in the lowest overall cost of capital is preferred to least to obtain a minimum overall cost. Capital structure which is not balanced will lead to the cost of capital is high while the present earning rate is low. Weighted average cost of capital is used as the discount rate to estimate the present value of the future flow. Average cost of capital also helps to ensure the firm is earning at the least of the cost of financing. Next, the marginal cost of capital. The marginal cost of capital are calculated as the last dollar of the capital rise. Marginal cost of capital happen when the last of the retained earning is depleted while the cost of financing are going higher. The marginal cost of capital can be increased as the amount of capital increase. Higher the cost, the common stock is substituted for the retained earning using the appropriate debt to equity ratio to maintain the most favorable capital structure. Okay, now I will explain about the cost of debt. Cost of debt is interest rate on a risk-free bond paid on the amount we borrow. Cost of debt can bring advantages to our company. First, the advantages of the cost of debt is more tax efficiency than equity financing. Next, the lender have no claim to equity in the company. Other than that, the lender also are only entitled to repayment of the agreed principal plus the interest. Next, a larger end gain is realized if you compare to equity that was sold to the financial group. On the other hand, the principal and interest repayment are structured and may be planned. The excess of debt will result in high leverage and higher lender interest rate and will be higher risk to the company. Moreover, debt is discounted by the tax rate for profitable firms. The after-tax cost of debt is calculated as... Okay, next is the cost of equity. The cost of equity is the money raised from the shareholder by issuing more share to shareholder or issuing share to the new shareholder and the dividend paid. Cost of equity is the approximated by comparing the particular investment of the other investment having similar risk profiles. The future dividend stream is estimated based on the firm's dividend history and an assumed growth rate. The calculated market capitalization rate is equivalent to the current market price. Firms' estimated dividend paying capacity that do not distribute dividends profit is from average cash flow and the net income which are compared to other dividend. Cost of equity can be approximated by using the Capital Asset Pricing Model or CAPM. So we can approximate the cost of capital by using the least square regression formula. Other than that, we also can use a simpler version of capital asset pricing model, which is okay. Now we look at expected return. Expected return is the anticipated amount that will be gained from the investment whose the rate of return is known. Expected return can be calculated by risk-free return plus with the security sensitivity for the market risk times with the market risk premium. Return of equity, ROE, is the net income return as the percentage of the shareholders' equity and measure profitability according to how much profit is generated with the shareholders' invested money. ROE can be calculated by net income will be divided with the shareholder equity. Net income is the full fiscal year. It is the income after dividends are paid to the preferred stockholder but before the dividends are paid to the common stockholder. To calculate the expected return on bond, first we must determine the bond's par, which is the actual issue price. After that, the price paid for the bond depends on the current rate and the bond market. Next, we determine the applied interest rate. Moreover, the calculate of the rate of return earned using the price paid for the bond and the interest received. Finally, we can calculate the interest that is paid.
Weighted average cost of capital in 3 minutes. Let's say you need money to do business. This is called capital. However, where do you get this capital? You get it from either the owner's money, called equity, or you get it from borrowing from the bank or other sources, called debt. If your capital is borrowed from the bank, does this have a cost? Yes, it's the interest on your loan. So if the interest rate is 5%, then your cost of capital is also 5%. But if your capital comes from investors instead of a bank loan, does this have a cost? Yes, it's the expected return of your investors. If investors are expecting a 10% average return by investing with you, then your cost of capital is 10%. Now here comes our problem. What if part of your capital comes from the bank, borrowing at 5%, and another part of your capital comes from investors, expecting 10%? Is your cost of capital 5%, like the bank loan, or 10%, like the investor's expected return? Of course, it's something in between. But not exactly in between, because you might have more of one than the other. So how do we get the exact cost of capital percentage? For this, we use the WACC, or weighted average cost of capital formula. Don't worry, it's much easier than it looks. It's called a weighted average because it gives more weight or importance to either your borrowed capital or your investor's money, whichever is greater. See? These are the basics to this super simple concept.
Now we look at capital structure. Capital structure is the how a company funds its overall operating and growth. Debt consists of borrowed money that is due back to the lender, commonly with interest expenses. Debts also allow a company to retain ownership, unlikely equity, because equity consists of ownership right in the company without need to pay back any investment. Additionally, in times of low interest rate, debt can be abundant and it's easy to access. Companies can gain some benefit from debt because it tax advantages. Interest payment made as a result of borrowing fund may be a tax deductible. A company that is heavily financed by debt has more aggressive capital structure and therefore poses greater risks to investor. The debt to equity ratio is the useful to determine the riskiness of borrowing practices. Equity allows outside investor to take partial ownership in the company, and this is benefit to the company in the case of declining earning. Equity is more expensive than debt, especially when the interest rates are low. However, unlike debt, equity does not need to pay back. On the other hand, the equity represents a claim by the owner on the future earning of the company. Finally, now we look at Modigliani-Miller, or we can call it M&M. M&M is the market value of a company is correctly calculated as the presented value of its future earning and its underlying asset, and it's depending of the capital structure. A company only has 3 ways to raise money to finance their operation and to fuel their growth and expansion. First, borrow money by issuing bond. Second, obtaining loan or reinvest their profit in their operation. Finally, they will issue new stock share to the investors. There is two concepts of M&M. First version of M&M theorem with the assumption of the perfectly efficient market. It implies the company operating in the world to perfectly efficient the market to not pay the tax. Moreover, the trading of security is executed without any transaction cost. Bankruptcy is possible, but there is no bankrupt cost. Information is perfectly symmetry, which is value of unlevered firms equal to value of levered firms. And then next, in perfectly efficient market, companies do not pay any tax. Therefore, the company with 100% leveraged capital structure does not obtain any benefit from the tax-deductible interest payment. Essentially claim the company's structure does not impact its value. Since the value of a company is calculated and present as the future company cash flow, the capital structure cannot affect to them. Second, the company cost of equity is directly proportional to the company leverage level. An increase in leverage level induces the higher default probability to a company. Other than that, the investors tend to demand a higher cost of equity in return to be compensated for the additional risk. Cost of levered equity can be calculated as this.